Everyone, we'll be doing other sources, income from other sources now. So income from other sources will I'll just give you an introduction of what amount is taxable. Under income from other sources, two type of income is taxable. Income which is specifically chargeable under this head, it comes under section 56(2). You write down 56(2) here, and other income which is a residuary head of income. Okay, so income which is taxable, normally which is taxable and it is outside the scope of other heads, then it comes to other sources. Okay, it can also be called the income from other sources can also be called a residuary head of income. This is 56(1). For 56(2), any income which is mentioned in 56(2) will specifically chargeable under other sources only. There is no dilemma whether it will be taxable under any other head of income unless specifically mentioned. Like here it is mentioned here, higher charges of plant machinery if not chargeable to PGVP. So it will either go to PGVP or other sources. If not the business, then it will come to other sources. No other head will come. Okay. So we'll just quickly glance through the incomes. Dividend, winning from lottery is 30%, standard deduct 30%. Straight away you have to pay the tax without expense, without deductions. Higher charges will have to be payable under other sources if not taxable under PGVP. Higher charges of only building is taxable under income from house property, but if the house property is rented together with other assets, then it will be chargeable under other sources because if your business is not to rent out building and other assets along with. Issue of shares by a resident to a resident by a closely held company. So when a closely held company issues shares, it may issue it at a premium. Is premium an income? Not compulsorily. So if in case a closely held company issues shares at a premium and the consideration received is more than fair market value, that amount will be taxable as 56 to 7b. Okay, in case of 56 to 7 and 56 to 10, there is a limit of 50,000. Here limit of 50,000 is not applicable. Now a venture capital company, venture capital undertaking, so a startup who is issuing shares. Now startups are valued at such an higher amount, so they issue shares at a premium of say 300%, 400%. And of course, as per the market value computed as per income tax, the valuation is higher. So that has been exempted from this provision. So if a venture capital undertaking is issuing shares to venture capital fund who is providing the funds or a venture capital company, then 56 to 7b is not applicable. 56 to 10 will be discussing separately. Interest received on compensation. Compensation is taxable under capital gains. Interest received on compensation is taxable under other sources. Advance money forfeited on or after 1/4/2014, it is taxable under other sources. If it is forfeited before, it will be reduced from the cost of acquisition in case of capital gains. Advance amount forfeited by owner before 1/4/2014 is reduced from cost of acquisition as per 51. Okay. Now this is 56, section 56. This provides for income. For expense, section 57 provides that these income, these expenses are allowed. 58 provides that even if 57 allows certain expense, I will disallow those expense. If say it is a personal expense, it is paid in cash. The payment is made in cash. Similar disallowance of 40A means 48(3), for example. It is payment is made in cash more than 10,000. Okay. Similarly, salary paid outside India and taxable in India and tax is not deducted. Disallowances will be made. 57 provides that dividend. Normally, dividend is an exempt income, so deduction of an expense is not allowed. But if the dividend received is not exempt income, like dividend income from foreign company, that will be against that income deduction will be allowed of commission or remuneration paid for realization of income. Similarly, interest on securities, even on that deduction will be allowed. Family pension in case of in event of death of employee, standard deduction of 1/3 of income or 15,000, whichever is lower will apply. Any income, for any income under 56 to 10 or 56 under 56 2 or 56 1, any income which may arise, you can take the benefit of this clause. Revenue expenditure laid wholly and exclusively incurred for earning such income. It is like section 37 in PGDP. Section 37 used to say any expenditure wholly and exclusively incurred for the purpose of income earning such income will be allowed. If it is not a personal expense, it is not a capital expense. Section 37 is more or less covered here. Okay. Interest received on compensation. Now, interest received on compensation which is taxable under 56 to 8, the deduction of 50% is allowed. So that is a standard deduction. No need to actually incur any expense. Okay. Now we'll start with the treatment of dividend. You have to focus in this part. Starting off, dividend is classified into section is defined under section 222. It says dividend includes. There are 5 clauses. Okay, A, B, C, D, E. It is defined in an inclusive manner, meaning dividend which is actually paid by the company is a dividend, and these 5 clauses are deemed dividend. Okay, so 222A to D there is a separate treatment, and 222E there is a separate treatment. Okay, for 222A to D, let's read the section of 222 first. 222 provides that distribution of assets, bonus to preference shareholders, debentures to any shareholders, assets on liquidation, reduction of capital. These are deemed dividend. 222E says loans and advances by closely held company. It is also a deemed dividend. Okay. Now treatment will classify the treatment 222A to D and 222E. From 222A to D, there is a separate treatment for company as well as for the shareholder. Same in case of 222E. Previously, dividend under section 222E was not exempt. Okay, but currently it is exempt. For 222A to D, it is exempt. It is exempt up to 10 lakhs. Section 1034 provides exemption, but also provides a proviso that it will be limited to amounts specified in 115 BBDA. Section 115 BBDA provides that the amount in excess dividend income in excess of 10 lakhs will be taxable at 10%. It is applicable to all. Section 115 BBDA says it is applicable to all assessee or resident person except these 3 persons: domestic company, 12 AA institution, 1023 C institution. 115 BBDA is not applicable to these 3 persons. So if a company is receiving dividend from another company more than 10 lakhs, 115 BBDA is not applicable. 100% tax exemption on dividend received. Okay, 115 BBDA is not applicable here. Due to shortage of time, I cannot explain you the interpretation and how the result came. But if you have to memorize this chart, use this. Right here, 115 BBDA not applicable. Means if a shareholder receives loan or advance by a closely held company, it will be exempt without any limit. Okay. Now we'll see the treatment in the hands of the company. For dividend, for specifically for dividend, there's a tax on distribution. Okay. For 115 115O provides that the amount distributed will read from an amount of distribution, following amounts will be reduced if the dividend is from subsidiary company. So suppose I am a company, I have an Indian subsidiary company, I have a foreign subsidiary company. From Indian subsidiary company, if I receive, that company will be liable to pay DDT. So if that company has already paid DDT, I'll get deduction. Indian company DDT is paid. For foreign company is not liable to pay DDT, hence shareholder is taxable. Okay. So if a foreign company is paying me dividend, I'll have to be I have a liability to pay tax as Indian company. Okay. So if tax under section 115 BBD is payable, then I'll get a reduction. Please remember, there's a confusion here with a lot of students. They say here it is a subsidiary company. Foreign company should also be my subsidiary. Indian company should also be my subsidiary to get a reduction. On the other hand, if you just make this mark and write here 115 BD is applicable in case I hold 26%, at least 26% of voting power in a foreign company. So if I hold at least 26%, I'll be liable under section 115 BBD. One one five BBD, I'll be liable to pay a tax at the rate 15%. Okay. Now, when the amount is reduced, you'll arrive at another amount. Say, suppose it was 115. Then we reduced 30. Then we got here by 85. Now we have the amount of 85. Will increase by 15% grossing up. 85 divided by 85 into 100. Is this right? So we'll gross up and we'll arrive at an amount, and then we'll apply 15% into 112% into 104%. This is 4% because we'll apply the tax rate of 15%, and then we'll apply surcharge of 12%, and then education cess of 4%. The amount so computed will be paid within 14 days of proposing declaration or distribution of dividend. Okay, if this is clear, so I'll again repeat the provisions. If that is clear, I'll discuss two more mistakes that students make. Okay, so first we'll take the amount that is actually distributed, will reduce dividend received from subsidiary company. Indian company DDT is paid, foreign company tax is payable under section 115 BBD. Will reduce, will arrive at an amount, will gross it up, reduce, increase, apply. RIA. Our memory technique is RIA. Will reduce, will increase, and will then apply. Increase by 15% grossing up, will apply 15%, 112% and 104%. So mistakes that students commonly make is that they first increase and then reduce. Whereas first we have to reduce the amount first and then gross up. The second mistake the students make is they increase the percentage. Say suppose 15 into 112% into 103%, and they gross up this rate to take up to come at a percentage of 20% odd amount. That is incorrect. Reason: the act specifically provides that the value is to be grossed up and not the rate. So for the presentation, we'll arrive at a value and then we'll gross it up. Okay. 222E provides that, so previously and currently, I'm discussing the current position after Finance Act 18. Now the company is liable to pay DDT. The companies will deduct the dividend from subsidiary company, etc. And then 30% is applicable. 30%, 112%, 104%. These rates are applicable to 222E. Okay. So this is the discussion that we had for 222 for deemed dividend. For since we are short of time, we cannot discuss in depth what are the implication, what is 222C, 222D, and their implication of capital gains in the hands of shareholders. 222E, there are three pointers whether loans and advances given to three persons will be taxable under 222E. We are not able to discuss if students require some portions of income from other sources. You can contact me or you can leave comments in the comment section and I'll send you the original file of other sources, the whole lecture. Thank you.